My favorite guest here is a young man. He follows us very, very closely. Thomas Hayes, the chairman and managing member of Great Hill Capital. Tom, it was really not meant to be a comment because everyone is young compared to me. But seriously, I always enjoy hearing from you because you give us a good perspective on this. And I'm wondering now, after these 9 down Dow days, I know we in the media can make a big deal of that, and there's no connection sometimes to the overall tone of the markets. But a bit of a relief rally today. What do you think?
Well, it's interesting. The 50% of the 1,500-point drop in the Dow, 50% was attributable to United Healthcare. As a matter of fact, healthcare relative to the S&P 500 is having its lowest performance since 2008. That was an enormous buying opportunity. So there's some...
And that downdraft of United Health it was happening before the killing of the CEO. But go ahead.
And it's exacerbated. And of the 500 S&P components, 62 are healthcare. The average healthcare stock, those 62, is down 19%.
Wow.
As Mark Twain used to say, the rumors of my demise are greatly exaggerated. This exact same thing happened in 2016 after Trump was elected before the inauguration. Remember, he was going to tear off the Affordable Care Act. It didn't happen with John McCain. And shortly thereafter, you saw biotech rally 75% the next year. Healthcare, the XLV, rallied 40% in the next year. So I think there's going to be a tremendous opportunity to take advantage of healthcare. And that's part of this rotation that you're seeing in December. The other part of it is tax loss selling. So what's performed this year? Growth has performed, so there's nothing to sell. People want to sell those after the new year. Some of the value stocks have underperformed, so they're selling in the hole to create tax assets.
So let's play out what we're looking forward to in the next week or two of this year. It's been an incredible year. The Dow, last 9 days notwithstanding, still up, I think, 17, 18% year to date. Can we keep this going in the new year?
I think it's going to be nuanced. I think Santa's going to come to town. We'll see a little bit of strength. Tax loss selling is over.
I don't know. Santa always worries me because he always wears red. You know what I mean?
That's a good point.
Watch out for the thinning color, I might point out.
The Grinch is green.
Right.
Hopefully there will be no Grinch this year. We do have strong earnings, but how much of that is priced in is a great question. I think returns next year are going to be slightly more subdued, 8, 10, 12% for the general indices. The other thing that we're seeing...
It's still not bad. We're just used to 26, 28, 30%. You know, Goldman Sachs is still saying 3% if we're lucky.
Yeah.
What do you think?
Well, you know, it's interesting. The correlations of stocks right now are at the lowest level in 24 years, going back to 2001, 2002. What that implies is that the 493 are going to start to pick up the slack, which means if tech does perform more modestly next year than it did this year, there's just tremendous ways to make money under the surface. So you have to be, I think, a little cautious if you're too overweight in all the stocks that are working. Some of them have become really fully valued, if not excessively valued in some cases.
You include the Magnificent Seven and tech stocks.
Yeah.
I find it always interesting looking at the Magnificent Seven, even though you get an NVIDIA that goes into correction territory, down 10% or more from its highs. Tesla balanced out the rest of the magnificent guys. Tesla a little under duress today, not much. But how do you play that out there? Because there are a lot of people who, just virtue of the strength of those stock performances, are disproportionately now in tech, a lot.
Yeah.
What do you tell them?
I think you want to look for simpler stocks in 2025. For example, Boeing is turning around, okay? New CEO is turning around the ship. The union problems are solved. The 737 is back online. That stock is starting to take off. No one's even talking about it. It's up pretty meaningfully in the last couple weeks.
We still have those astronauts.
Yeah.
I mean, but Wall Street doesn't seem to care.
No,
but, you know, let's face it, Boeing still has a whole heap of problems here. But I guess is the sentiment here that it was overbeaten, and is this a genuine turnaround?
No question about it. Look, they have a 10-year, $500 billion backlog. The beauty is it's a duopoly. If you want a plane, you can only get it from Boeing or you can get it from Airbus. And if you say, I don't like Boeing, they were a disaster, well, then you got to wait 20 years from Airbus. So they're going to fix it. Kelly Ortberg at Rockwell Collins, he created a 4-bagger in 6 years for his shareholders. So he's going to turn that around. He's going to right the ship. Another simple one is Disney. That's still down 50%. You can't give the stock away. It's starting to recover in the last few months. Again, no
How
one's
do you
talking
play that? You know, because I've asked this before, but, you know, there's that play the dogs of the Dow, for example, and they'll have their day.
Yeah.
But sometimes the dogs can still bark for a while before, or you can get foolishly drawn in and realize, oh, wait a minute, there's no here.
Yeah, I think the key is low to no leverage. That's where people really get hurt, is if they buy too much on leverage. Just buy the position and know that over time, good quality businesses always recover. The number one thing.
So that extends to Disney.
That extends to
and
Boeing.
Does it extend to the borrowers who want to go in and buy some of these stocks then? Or because some of them are borrowing on leverage of their own, margin accounts of them.
Yeah, I think that's a way to get yourself stopped out and nervous too soon with good quality businesses. You know, good things come to those who wait. Some come faster. The name of the game with a turnaround situation, when it's a quality, durable business that's been around for decades and you know is going to be around for decades to come, is just solvency risk. If there's no solvency risk, which Boeing had a little bit of, people were a little bit worried, but they raised $20 billion of cash, they're going to be fine. And Disney now is cash flow positive on the streaming side of the business. In those cases, just wait and they will start to recover over the next couple of years. You'll be very happy. You don't have to guess the future. You don't have to guess who's going to win the AI game. You just say, it's Disney. Everyone loves Disney. It's Boeing. Everyone loves to fly. It's going to recover. These stocks are down materially from the COVID highs. They're going to come back.
But the rally continues in aggregate, just not as crazy as we've seen.
I think the index holders will be underwhelmed, and I think there's going to be great opportunities under the surface as this continues to broaden. Remember, other than the last 10 days, we saw a real change, real broadening since the summer.
Absolutely.
This is a pause that's going to refresh, and I think we're going to see that 493. And a lot of the money is going to be made in names we haven't been talking about this year, and that's what I'm
493, the other S&P 500 stocks, not just those big seven.
The other thing is, in Trump 1.0, everyone was worried about ex-US. So no, you can't give away an international stock right now, whether it's emerging markets, Europe. I think there's some value there. I think you want to start to get some allocation. You don't have to go crazy, but I do think what we saw in his first year, they outperformed. So that could be a surprise for 2025, Neil.
Yeah, these global ETFs are already percolating. So we'll watch what happens. Tom, good seeing you. Have a Merry Christmas so we don't chat again. Thomas Hayes follows this very, very well. When it comes to